Hey, welcome back. This is Mr. Market. We are now into episode 12. Thank you so much for joining me. We had a pretty rough week. SPY had its worst week in all of 2023 and its worst performance in about half a year. And we have to go back all the way back to that plunge in September to see anything as bad as this. For the week, the market was down 4.5%, which means that the market gave up pretty much most of its gains for the year. After being up as much as 9%, it's only up about 0.9% for year to date. And as for us, we ended up having our first losing week too. So much for that pipe dream for having no losing weeks this year, but that's how it goes. The markets are rough sometimes, and even though we had our protections, it didn't protect us all the way. And for the week, we were down $1,404, putting our year-to-date gain to up $14,404. So we're still about 29% of our target for our goal of reaching $50,000 a year off a $250,000 portfolio. So we're aiming for 20% a year. And if our positions work out for this following week, we'll be able to make more than what we lost last week and put ourselves back at new all-time highs. But one of the cool things about our strategy is that even though the market fell 4.5% last week, we were able to avoid about 85% of the damage, and we were only down about 0.66%. So that's why our performance has been so good. It's because of how we play defense. When we take a look back at how we've been trading ever since we started using the pendulum algorithm, we started using that in July. There have been about 36 weeks since we started. Of those 36 weeks, 19 weeks have been down weeks for the stock market, and for us, we've only had 6 down weeks. So we've been able to avoid about 68% of the down weeks through our conservative investing approach. And because we had our first losing week of the year, I decided to dive a little bit more into the numbers to see how we perform when we actually do have down weeks. And so I looked into something called the up capture and down capture ratios. And basically those ratios tell you the percentage of the move that you participate in on the upside or on the downside. And typically you want to have high up capture ratios and you want low down capture ratios. And what I found out was that when the markets go up, our portfolio tends to go up about 0.51%. So if the market's up 1%, we're up 0.51%. So our up capture ratio is 0.51. That's not impressive or anything, but it's decent given our lower risk strategy. But this is where we really shine. If you take a look at the down capture ratio, now remember, we want to have it as low as possible. And our up capture ratio is 0.5. Now our down capture ratio is not 0.5. It's lower than that. It's not 0.4, it's not 0.3, it's not 0.2, and it's not even 0. 0 would be pretty phenomenal because that would mean if the market falls, we don't even budge. But do you know what our number is? Our downside capture ratio is negative 0.2. So what that means is that when the market falls 1%, we are typically up 0.2%. That's how stable our strategy is. And that's why we've been able to outperform, is that when the markets fall, we have a stable strategy that makes money in up and down markets. So enough about that. Let's talk about what drove the markets down this week. The biggest thing was we had a couple of banks collapse. We had Silvergate Bank, which collapsed because of its exposure to cryptocurrencies. And the big whopper was the collapse of Silicon Valley Bank. This was the 16th largest bank in the US, and this was also the largest bank to shut down since 2008. The number one bank to shut down was Washington Mutual. And so this is the second largest one to collapse since 2008. So this event is considered a Black Swan event, which is something that is rare and also hard to predict. And it can have some consequences for the market. And as we've seen, a lot of the banks got hurt for the past week because a lot of people are afraid that what happened to Silicon Valley Bank could also happen to a lot of the other banking companies. So the problem with Silicon Valley Bank is something that kind of bothers me because a lot of banks kind of have the same practice as they do. So when you're a bank, you are allowed to report on your balance sheet two values for the investments that you have on your balance sheet. So if you have something that you're going to sell or hold within a 1 year period, that is called available for sale securities. And those are investments that you have to put on the balance sheet at its fair market value as of that point in time. But if you have something that you're going to hold all the way to maturity, say if you have a long-term bond, that matures, maybe 20 years away, even if the value of that bond gets totally crushed, the way the bank accounting rules work is that you don't have to report the lower value of those bonds on your balance sheet. You can just report it at your original price. And it's like this conversation that you may have seen. Hey Chad, you know that GameStop you bought at 400 a little while ago? It's been starting to go down. Aren't you a little bit worried about it? No way, bro. Just wait until the real short squeeze happens and I'll make my money back. Don't forget, it's not a loss until you sell. So yeah, Silicon Valley Bank pulled a Chad and basically said, it's not a loss until you sell. And, people really didn't notice it until the bank came out and said, hey guys, sorry, we kind of need to go raise some more money. And then all eyes were on them and they realized, holy moly, these guys have a really big problem. On their balance sheet, they were able to not report $15 billion of losses because of this accounting rule. And they took advantage of it. And so the $15 billion in losses, if you compare it to the amount of capital that they had left in the bank, their bank was worth only $16 billion. So almost all of it was entirely wiped out. And so, you have to watch out for these other banks because they're not the only ones that have this type of practice. So in fact, Morningstar put out a list of 20 banks. They broke it down into categories of 10 banks that had declining interest margin trends, and then another list of 10 banks that had this high proportion of these unrealized, unrecognized losses relative to the bank's total capital. And these 20 names, I think, are going to have quite a bit of problems with regard to at least market perception. And so for anyone out there who has deposits in these banks, you might be a little bit concerned because if there is a run on those bank assets, then these companies could shut down just as easily as Silicon Valley Bank. And it wouldn't surprise me if some hedge fund out there shorted all these companies that were on this list and then simultaneously went long or bought some high quality banks that didn't have these kinds of exposures just to go hedge their risk. Now, I'm not recommending any buys or sells on these companies. This is not financial advice, but I just want you to be aware of the risks. Take a look at those banks on this list and, try to make sure that your deposits at least don't exceed $250,000 because that's the amount that the FDIC will insure your deposits amount. So just keep an eye out for it and be safe. So the situation with the Silicon Valley Bank kind of puts the Fed in a pickle because, last week we had a strong jobs report that showed we created over 300,000 jobs in the previous month. And that pretty much gave the go-ahead for the Federal Reserve to keep raising interest rates. The market originally was expecting interest rates to go up about a quarter percentage point, but with the recent testimony from Chairman Jerome Powell and the recent strength in the jobs numbers, the market has started to go price in the possibility that the Fed will raise interest rates by 0.5%. So, as the interest rates keep rising, the problem is that can also reduce the value of the bonds on a lot of these banks' balance sheets. And so, can the Fed raise it 50 basis points? Can they raise it 0.5%? Because the higher they raise it, the lower some of these longer term bonds are going to be valued at. And that makes the banking system a little bit more fragile. So it's going to be a little bit tricky. And the market understandably got really nervous about this. So with all that said, what am I doing with my portfolio for the coming week? Well, on Tuesday, we have another CPI report, which always seems to be moving the markets pretty strongly. So that's a source of volatility. On Friday, we have the S&P 500 ETF paying its dividend. And one thing I noticed is that the day before, usually the volatility seems to spike a little bit. So we could have a little bit more volatility because of that. For me, I put out some bets on SPY at 375 and 370. And here's why. So typically, my unscientific observation has been that during this recovery phase, the market can fall up to about $30 from its recent peaks before it pivots and rebounds again. And the market roughly peaked at about $418, and then we got to about $385 on SPY. So, that was pretty close to my $30 price target. And on top of that, my other unscientific observation is that the market tends to drop about 2% for every expected rate hike equaling a quarter percentage point. So now that the market is expecting the Federal Reserve to raise interest rates by 0.5%, based on my unscientific observation, you would expect the market to drop about 4%. And lo and behold, that's how much we fell last week, 4.5%. So that's another reason I think we may be pretty well priced in for the risk that we have for the market. And also, if you take a look at the relationship between stocks and bond prices, specifically the 10-year bond yield, if you look at where bond yields are now, bond yields dropped quite a bit last week. There was a flight to safety. People sold off stocks and decided to go buy bonds. And when the price of bonds goes up, the yields go down. And when the yields go down, that allows you to have a higher valuation for the stock market. I know it's kind of crazy. But so now if we take a look at the current level for the 10-year bond yield, the fair value for the stock market is somewhere around $380 to about $390. And since the market, ran right through the 200-day average, and it ran right through the 50-day moving average, there's a little bit of fear out there, and I'm trying to be cautious. So that's why I'm below that really strong support level at $380, and I put myself at 375 and 370. But one other thing to note is that the volatility index had spiked to such a level on Friday that it pretty much signaled panic. And whenever you have panic conditions, and whenever the volatility index spikes above the 2 standard deviation mark, more often than not, that has tended to give a pretty good buy signal. So I know the pendulum algorithm is pretty bearish right now, but all those things considered, I'm actually fighting this algo signal right now, and I'm just using my pure instinct and experience to try to have some exposure here. And if it works, then great. If not, then at least I have some downside protection, and I'll be able to roll down if the market falls apart. In any case, I think this is a pretty decent bet. Kids, don't try this at home. And so that's all I've got for today. Thanks again for watching me. And as a reminder, please click like and subscribe so you can see me every single week. And good luck to you, good luck to me, good luck to us, and I will see you next week.